Gold is once again proving why it has long been considered the world's most reliable safe haven asset, while Bitcoin continues to lag behind, reopening a long-running debate over whether the cryptocurrency truly deserves the label of digital gold. As global uncertainty rises, investors are increasingly focused on protecting their capital rather than chasing high-risk returns. Gold prices are hitting fresh record highs, while Bitcoin has struggled to hold key psychological levels, behaving more like a speculative asset than a dependable store of value. The growing gap between the two has forced both retail and institutional investors to reassess Bitcoin's role in their portfolios. Gold's performance in 2025 has been historic. The metal is up more than 70% so far this year, marking one of its strongest annual rallies in decades. Silver has posted even bigger gains, climbing nearly 150%, while platinum has also surged to record levels. Together, these moves represent the strongest year for precious metals since 1979, a period remembered for inflation shocks, geopolitical turmoil, and deep mistrust in fiat currencies. Bitcoin, by contrast, has struggled to maintain momentum. Although it has experienced sharp rallies, those moves have repeatedly faded as traders quickly lock in profits. Over the past several weeks, each attempt to push higher has been met with selling pressure, signaling weak conviction and lingering caution across crypto markets. The divergence is especially striking because the current macroeconomic backdrop should, in theory, favor Bitcoin. Rising geopolitical risks, concerns about long-term currency debasement, and expectations for interest rate cuts are conditions often cited by crypto supporters as bullish for digital assets. Instead, those same forces have overwhelmingly benefited gold. One key reason is a shift in market psychology. Investors are firmly in capital preservation mode. Bond yields have been volatile, currency markets have swung sharply, and equity markets have struggled to find direction. In such environments, investors typically seek assets with long histories of stability and broad institutional acceptance. Gold fits that role. Bitcoin does not, at least not yet. David Miller, Chief Investment Officer at Catalyst Funds and Portfolio Manager of the Strategy Shares Gold Enhanced Yield ETF, said the contrast between gold and Bitcoin has become difficult to ignore. Gold has had a record year, and while Bitcoin has had strong periods, it hasn't delivered when it matters most, Miller said. That's why the idea of Bitcoin as digital gold still doesn't fully hold up. Another major driver behind gold's strength is sustained buying from central banks. In recent years, central banks, particularly in emerging markets, have steadily increased their gold reserves as a way to reduce dependence on the US dollar and protect against long-term currency risk. That trend has continued into 2025. Data from the World Gold Council shows that gold-backed exchange-traded funds have seen inflows in nearly every month of the year, pointing to steady accumulation rather than short-term speculation. Holdings in the SPDR Gold Trust, the world's largest gold ETF, have risen by more than 20% this year, highlighting strong institutional demand. Bitcoin lacks this level of official endorsement. While some corporations and investment funds hold Bitcoin, it is not recognized as a reserve asset by central banks. Regulatory uncertainty, price volatility, and concerns over market structure continue to limit broader institutional adoption. What gold can do that Bitcoin can't is serve as a true alternative reserve asset, Miller said. Bitcoin is still largely a retail-driven market, while gold is deeply embedded in the institutional system. Expectations for interest rate cuts have also failed to provide meaningful support for Bitcoin. While lower rates generally weaken fiat currencies and support hard assets, Bitcoin typically requires more than just easier monetary policy. It tends to perform best during clear risk-on periods, when investors are comfortable deploying capital into volatile assets. Right now, that risk appetite is missing. Markets remain unsettled, with bond yields swinging sharply and the US dollar whipsawing. Investors are reducing exposure to high volatility assets, and Bitcoin often sits near the top of that list. Positioning within the crypto market has added further pressure. Bitcoin spent much of the past year trading in leverage-heavy environments, particularly in derivatives markets. As those leveraged positions unwind, rallies have been capped and downside pressure has increased. Gold's rally has not occurred in isolation. Silver and platinum have also surged, reflecting broader demand for hard assets. Silver's strong gains are supported not only by its safe haven appeal, but also by rising industrial demand, particularly from renewable energy and electronics. Platinum has benefited from supply constraints and renewed demand from the automotive sector. The strength across precious metals suggests a broader shift in investor behavior toward tangible assets. When multiple metals rise together, it often signals a deep and sustained move towards safety rather than a short-term trade. Despite its recent struggles, many investors still believe Bitcoin has a long-term role to play. Supporters point to its fixed supply, decentralized design, and global accessibility as reasons it could eventually function as a hedge against excessive government spending and currency debasement. Global debt levels remain elevated, and fiscal deficits continue to expand across major economies. In that context, Bitcoin advocates argue that digital assets could become increasingly relevant over time, even if they struggle during periods of market stress. Critics, however, argue that Bitcoin's volatility undermines its usefulness as a store of value. While gold prices do fluctuate, those moves are generally far smaller and less frequent than the swings seen in crypto markets. Bitcoin may mature into something closer to digital gold, Miller said. But it's not there yet. Gold's role is established. Bitcoin's role is still evolving. Wall Street banks remain broadly bullish on gold's outlook. Goldman Sachs has forecast that gold prices could rise toward $4,900 an ounce by 2026. Under its base case scenario, citing strong central bank demand, geopolitical risks, and long-term concerns about fiat currencies. Other banks have echoed similar views, pointing to limited supply growth and continued institutional buying as key supports. As real interest rates are expected to trend lower over time, gold's lack of yield becomes less of a disadvantage. For many portfolio managers, gold is once again becoming a core holding rather than a short-term trade. The debate over Bitcoin as digital gold is far from over, but it is clearly being tested. In an environment dominated by uncertainty, caution, and risk aversion, gold has delivered exactly what investors expect from a safe haven. Bitcoin has not. That does not mean Bitcoin has failed entirely. It remains one of the best performing assets of the past decade and continues to attract capital, innovation, and attention. However, when investors prioritize stability over growth, they continue to turn to the original hedge rather than its digital alternative. For now, gold remains firmly in control of the safe haven trade, while Bitcoin's role continues to evolve, and the gap between the two tells a clear story about where investor confidence truly lies.